Hi traders, what we're going to be looking at here is assessing direction and potential for trades, which obviously is an important question. Is this the right place to trade, and in which direction am I going to trade? So here we have a chart that's, and obviously we're looking at the right hand side here, but you see it's had a bit of a push down there from a level of support, and it's now retracing back. Now the question is this going to carry on an uptrend, or do we have resistance levels and support levels that may support trade in the ongoing downtrend that's been happening? So first port of call is to draw some Fibonacci levels in. For those of you who don't know what Fibonacci levels are, they are levels used by the big dog traders. There we have a cluster from that high there. So I'm not quite on the high there, but yeah, there seems to be a cluster with the 50 and the 61.8 there. And let's just see. That's the same level. Yeah, nothing there. But there we have a 38 clustering with the 50, which is also clustering with the earlier 61.8. So there's a triple cluster there. My Fibonacci levels just playing me up a bit there. So at that level there, we have a strong level of support. A strong level of resistance showing. So I'm going to take some interest in that level, especially since we've just turned up to it. Now it looks like there's been a technical reaction to that level already. So obviously it's a recognized level of resistance, which is quite close to previous support as well. Just checking that the levels I've used are actually highs. And then that is, so yes, we just to show that 61.8 clustering with the 38 and clustering with the 50% as well. Quite a strong resistance level there. We just mark that area in so that we can keep it, and we'll get rid of the fibs so that we can clear up the chart a little. There you go. So you can see that price has pulled back to that level and then dropped off a bit. Now on the hourly, you can clearly see a very if you know about trend flow analysis, then you've got a bit of we're in an uptrend there, and we have a little bit of divergence on the MACD, convergence on the RSI, but the stochastic is clearly in a position to downturn, and then we have this pause in price action, which is indicated by the small candle at the top there, which is associated with the resistance level, which has also acted as early support as well. That's further back in time as well. You can see that nice little, very small rejection candle there, actually, a little doji. If I were to zoom in, I'll zoom in a bit, you'll see that's actually a kind of a shooting star type formation. For those of you who don't know about candlesticks, I speak about this further. You can go to my website at netresource.org.uk and look up some information psychology there. And there's also a course that I run, which is a one-time mentoring course. It's without limit of time, and once you enroll, take you through staged learning and mentor you through to successful trading. Now you can clearly see a shooting star type candle at the point of resistance there. Now this is a counter trend trade, but you can clearly see there's been a technical reaction there. And if you were to take that candle there, oops, frame me up a bit. One second. Trying to grab that. Sorry for that. Yeah, there you go. So you can see you clearly very quickly got a 1-to-1 there. So possibly a 2.5-to-1 there, even including the spread. It's not showing on the chart at the moment, but there's quite a small spread on Brent crude. So if you had worked off that resistance level there, which is indicated by the cluster, you could have actually used a candle potentially. It is a riskier trade using the candle. Some would use the previous high above that, which is just to the left there, or some people will use an arbitrary but consistent stop loss of around about 30 pips or so, depending on the currency pair that you're trading, of course, and the time frame that you're using, and then perhaps go for a 1-to-1 with the stop loss that they set themselves. But obviously, if you're looking to trade accurately and use price action for trading, you are looking to respect the candlestick psychology and resistance levels. And there is an argument that if it does go above that, then the trend is continuing up, and you're more likely to get to want to trade perhaps off the technical reaction from that resistance level, which was the triple Fibonacci cluster, because we're still in an uptrend there, and it's currently a counter trend trade, but you are working off the technicals. Not always advisable. It's a much riskier trade. It takes a fair bit of experience to be able to trade off the technicals for a counter trend move. But as you can see, quite often in the markets you will see a technical reaction to technical indicators within the market. So yeah, you have a clear uptrend. It's hitting clear triple cluster of Fibonacci levels, which is at a logical level of the higher time frame retrace. So the question here is what you need to ask yourself is, is this a place to trade? As I've said, that if you were to trade here, it would be a counter trend trade in relation to the initial trade direction, and it's risky. It could still potentially push up higher and show some more divergence. You may actually see some divergence come into the RSI as well, as price pushes up a little bit higher, which would then move up to a higher technical level most probably, before finally pulling back. But you can clearly see that there's been a technical reaction there at that level, and by technical reaction I mean that a lot of traders would have put orders in there, and then that reaction happens as those orders are triggered, and you can see the price is just shot down, and you can get quick trades off that if you want to sort of risk counter trend moves. Now what I've been doing here as I'm talking is I'm drawing in the daily range, which I discuss further in courses that I run. But it's a higher probability range for the day is what I've drawn in there with those two blue lines. And as you see, it's moved up, not quite up to what I'd consider the higher range for the day, but there is potential for this now to downturn. It could move up a little bit higher, but if you had traded that candle, then you'd already be probably out of the trade anyway. Or what a lot of people do would take out 1-to-1, a partial profit, 2-to-1, take another partial profit, and then perhaps let the trade run in case it comes further down, and perhaps move in their stop loss to break even, so they don't actually lose any money. Some people will move their stop loss even in the direction of the trend to break even. It's not always advisable because quite often price will come back, retrace, stop you out at your entry level if you've moved your stop loss up. But there are strategies that actually promote that, and they are successful strategies. They have a high success rate. You can see the divergence here on the lower levels, lower time frames rather, and the immediate divergence. That's not really relevant. Stochastics and convergence and price action there and indicators. Not too much to say about that. But you can see now in the lower time frames that a little bit of a downtrend may be forming. That if it comes down below that candle there, you then be in the downtrend, and you could trade off the technicals within that downtrend then. So I'll be looking at this now further to see if a downtrend forms on the low time frame, with a view to that trade continuing, on the basis that we have that strong resistance level there. Higher time frame, it's at a logical level of retracement on the higher time frames as well. So all these things are stacking up your trade probabilities in your favor for actually relying on market creating a turning point here. So quite a high likelihood of it starting to turn into a downtrend. Could still, nothing is guaranteed in the market. Price could continue retracing before it pulls back again. But I am personally looking for a bit of a turn here. But that will, whether I trade that will depend on whether a trend is formed and if the technical is supported at the time of trading. Okay, hi traders. I just thought I'd show you the outcome. This is actually, what date is it? It's 13th of July, and it's 7:15 in the morning. It's Monday morning after the weekend. I thought I'd show you the outcome of the Brent crude trade on the earlier video analysis. So here we are. This is Brent crude. As you can see, this is the candle that we were referring to earlier. Let's get rid of the data tips here. This is the candle we were referring to earlier, and that's the initial technical reaction that we've had. And then price has continued to fall off. Where would you enter there? Of course, because we didn't come in until after this reaction. Looking at that analysis. So, but that doesn't stop you trading. What you can do is you don't just jump into the market. You can scale down and look at lower time frames, and so this would have been our area here of the rejection candle on the hourly, and as you recall, price came down and we were in this area here on the last video, and then I was saying that if price came below this level, that's this level here, then we'd be in a downtrend. Let's try and draw a straight line there, and sure enough, price has broken that level, and then it's come back up, and now we have a potential area for trading here, and you've got a clear good trade there on the downturn of good risk reward ratio. You would have scaled out and not lost any money on that trade, and had you kept well, you would have been stopped out there, but I'm not seeing another entry there. But certainly, if you'd been trading up here, you'd still be in the trade, and prices really dropped off. But likely, if you trade in this area, you've had a good return, and price has continued to fall off. But that's the market. Sometimes you get stopped out and see price continuing your way, but you just take that in your stride and move on. Look for other entries. Don't just rush in. Price could have come back and continued up, and if you left yourself in the market, you'd be worrying about losing more money now. So take the money, have a logical entry and a logical exit, and allow price action to determine whether you're stopped out or not, based on your technical assessment of the price action and other technical factors. So a good trade there on Brent crude, even though it was a counter trend trade that we highlighted. You can see that the market is clearly dropped off after Friday. That was Friday, July the 12th, 11th, 10th, I think, 2015. So even with the late entries, you can still get the trades. If you've missed something on a chart, you can scale down and look for tighter risk rewards. We came in late. The prices really dropped off. Had you risked that candle, that's a fantastic risk reward ratio. And if you'd just remember me saying, if you took a 1-to-1 partial, 2-to-1 partial, brought your stop loss up, and allowed it to float, you'd be, sometimes if you take the risk, you can get good rewards. Obviously, you can also get stopped out, and if you don't know what you're doing, which is a flaw that often new traders have, is that they try to get the turning points. I did say this was a high risk trade, and this is what some newbie traders do. They go for these turning points, and quite often, or more often than not, will be getting stopped out very quickly as a consequence. So if you want to learn to trade, do visit the website or subscribe to the channel, where you'll get notified of new videos being put up. But for further information and training on technical analysis and how to trade with ongoing mentoring and support, do visit the website at netresource.org.uk, where there's more information and resources, and you have the option then to get on board and begin to learn to trade for yourself in order for you to make some money out of the markets. You do this with one-to-one support along the way, and always feel free to ask questions if you do enroll. Otherwise, happy trading.